Okay, so this paper is about longevity risk transfers. So in particular, what we are going to look at is something a bit more fundamental about the behavior in the market. So we are going to look at the impact of risk aversion of the two parties in the longevity risk transactions, and the impact of risk aversion on the preferred contract structure. So I'm going to talk about the contract structure a bit later in the talk, and the preference for market sectors in longevity risk transfers. So we consider this a slightly more general paper than most of the actuarial science paper on longevity risk. Okay, so to begin with, what is the definition of longevity risk? Right. So based on OSFI, it's sort of like a public institution in Canada. So the longevity risk means the risk of pension participants or annuity or life policy holders living beyond expectation, right? So basically, it's people living longer than expectation. And longevity risk is about the life and death of people. So it is a long-term risk, right? So for each cohort, especially young cohorts, it could span several decades, right? 5 or 6 decades or longer. So it is much longer than all of the property most, right? Not most of the property and casualty risk, right? So for P&C risk, you have policies about maybe a year or a few years. That's typically the case. But for life annuity liabilities, it could be several decades, right? So it's very different. And obviously, there is a ongoing life expectancy lengthening, so population aging, right, in the world. So because of that, the risk exposure for a lot of institutions, including pension funds and insurance companies and reinsurance companies, have been increasing over the years. And as a result, they have a stronger demand for longevity risk transfer solutions, right? They want to get rid of their longevity risk because for many institutions, such as pension funds, it is probably not their expertise to manage longevity risk, right? So they want someone with more expertise and more resources to manage the risk for them. Right? So they have a incentive to transfer those risks away. And because of that, we have seen a steady development in the longevity risk transfer. So I'm just going to call it LRT market over the last 2 decades. So basically, the more than longevity market started in 2006 in the UK, and after that, it has been growing pretty fast. Okay, so here I have the figure. So this figure is taken from a recent sort of like a summary of longevity risk market by David Brake et al. Last year. So from this figure, we can see the growing volume of longevity risk transaction over the year from 2007 to 2022. And so currently in the world, there are a few major, countries or regions for longevity risk transaction. So the largest country is the UK. There's no doubt about that. So if you look at the middle two region to area, so for buying and buyouts alone, there is already $281 billion dollars of it's US dollars of transfer. And for the longevity risk transfer transactions, there is a 190 billion transfer, right? And the US is also a pretty large market, and Canada is, also a very big market here. Okay, so this is basically the idea of longevity risk transaction market, the status of the market. We can see that it's growing pretty fast. Okay, now let's zoom in a little bit and look at the market itself. So in the longevity market, so obviously longevity risk is a risk that pension plans and insurance companies have. And for these institutions, when they think about de-risking, I guess probably the first thought would be reinsurance, right? So insurance company would go to reinsurance companies just hoping to offload their risk. So as a natural consequence, for the moment, most of the longevity risk transfer transactions happen in the reinsurance sector. So this is a very well-established market. So it means that obviously all the longevity risk is transferred to reinsurance companies, and because of the expertise and the well-established market in the reinsurance sector, most of the transactions are long-term. Okay, so you may think this is very natural, right? Because longevity risk is a long-term risk. So if I want to de-risk, I would want to sign a long-term contract, right? To get off my long-term risk. Ideally, if I have the option as a pension plan, for example, I would rather sign a long-term contract, such as a buying or buyout or a long-term reinsurance to get rid of all the risks at starting today, right? I don't want to sign like a 1-year contract, and then I have to renew the contract next year, possibly facing newer terms, maybe unfavorable terms, probably. I don't want to renew like every year for 50 years, right? So this is not really de-risking. So if I do that, I still have a lot of uncertainties. Anyway, so long-term agreements are good, okay, so for a long-term risk, right? So this is good. And because of the agreements are all long-term, so the hedge liabilities, everything should be defined at the contract inception, right? So how much of risk you want to transfer, something like that, right? Everything should be decided, everything should be calculated using the parameters, using the information at the time of contract, in inception, right? Okay, so and then just some side information. So far in the market, longevity swaps and longevity reinsurance are the main products. So for these products, when you think of just a bit of background here. So when you think of reinsurance, so basically typical reinsurance products will cover all the payouts, right? So if you have a loss, they will cover the loss, no matter what the reason, well, which reason caused the loss, right? Something like that. And in terms of pension payments, for a pension fund, there are all kinds of risks, right? Longevity risk is one of them. You also have investment risk, right? So what if you make a poor investment decision and you don't have enough money to cover, your pensioners? Well, this is also a risk. So for traditional reinsurance products, the reinsurance company will cover all the risks. So right? The reinsurance company, after taking the risk, they will be committed to cover all the pension payments, no matter what they are, right? So in that case, the pension plan would be transferring all the risk to the reinsurance company. So that is the traditional product. But in here, longevity swaps and longevity reinsurance are a little bit different. So the payoff of these products, they depend only on the realized mortality rates of a pension plan. So it means that investment is the pension plan's responsibility, right? So all the legal risk, all the other risks are the pension plan's responsibility. The reinsurance company are only going to cover the longevity risk, something like that. So it's a little bit different. So it's sort of like you separate longevity risk from everything else. So as a result, these kind of products are cheaper, right? Naturally. So this is just some background of the existing transactions. So here I just randomly took the two most recent longevity risk transaction from a website. So you can see it here. It's from the Artemis website, which collects all the LRT transactions up to now. So these are the two most recent ones. The first one is signed between NN Group in the Netherlands and an insurance subsidiary of Prudential and Swiss Re. So this was in December 2023. So you can see the terms here. So basically, they specify that I'm gonna transfer the pension liability of around 300,000 pensioners in the Netherlands, and based on all the information, the life table, based on all the assumptions at that point of time, the estimated liability would be 13 billion euros, right? So everything is fixed. So by signing this contract, NN Group will get rid of the longevity risk, okay, of these 300,000 pensioners for life, something like that. And the second example, it works very similarly. So this is the UK pension plan and Munich reinsurance, Munich Re, right? So it's in November 2023. The idea is pretty similar. You specify how many people you want to cover, right? 14,500 pensioners, and based on the parameters information at that point of time, the estimated liability would be £2 billion, and both contracts will continue until the portfolio has run off, meaning that, yes.
A quick question. I'm not really sure I understand. But in the previous slide, you said that there's this original way, sort of classical way to do the longevity to the pension fund, essentially,
Yes.
reinsurance.
Yes.
How does it work? I mean, for longevity risk, when you do it risk by risk, I understand. You can probably say, okay, threshold is a, let's say, portfolio, like pool of people. If they outlive by such and such, then the reinsurance is being triggered.
Yeah.
How does it work if you have a pool of risks?
Well,
do you connect it to the surplus?
Well, so in that case, the reinsurance company, for example, would just take over all the assets and all the liability associated with a pension portfolio.
But when the reinsurance is triggered, what is the triggering event?
So at time zero, the reinsurance company take over all the assets and all the liabilities of a pension portfolio, and maybe they will charge a premium on top of that. And after time zero, it is the reinsurance company's responsibility to make all the pension payments.
Oh, but then this is like as if they were to sell the business entirely to the reinsurer.
Exactly, the pension business.
Oh, I see. Okay, so this is not the de facto reinsurance. This is like you take the liability entirely. It's not like there's a deductible or
exactly
a threshold. They just take the whole line of business and just send it to the reinsurer, and the reinsurer isn't okay.
Yes. Well, I agree. It's technically not a real reinsurance agreement. Yeah. So this is actually what I just said is actually called a pension buyout. So basically, you find a reinsurance company that buys out your whole.
Yeah. If it's a buyout, then it's clear, right?
Right. Yeah. So So buying and buyout are more traditional approaches before this like new longevity swap thing came out. And buyout, as you can imagine, is going to be very expensive, right? Because the reinsurance company has to take over everything and all the legal risk, everything. Yeah, it's the reinsurer's responsibility. So it's pretty expensive. Yes. Oh, yeah. But this is just two examples of a longevity swap kind of thing. So just a remark here. So now the liabilities, the 13 billion euros and 2 billion pounds, they are only associated with longevity risk. It's not reinsurance or everything else. So this is what a contract may look like. So everything is specified at time zero, and then it continues until everybody dies, right? Until the portfolio runs off. Okay. Now, so this is the reinsurance sector. So far, so good. The reinsurance market is running very, very well. You see growing volume. It's very healthy, very good. But on top of that, literature has been arguing an alternative LRT solutions. So what they are saying is, so basically this is what people call the longevity linked capital market. So the argument there is that, okay, so the reinsurance sector is working pretty well, but it's just for now, because if you look at the pension liabilities all over the world, or more broadly speaking, all the life policies, liabilities all over the world is so big that at some point, the reinsurance sector does not have the capacity to reinsure all of them, right? So if that day happens, then, the reinsurance sector or the longevity risk market as a whole, it may need some extra, external capital, right, to insure or to reinsure all these risks. So actually, anyway, you need to find external players to this market, and a very natural candidate would be capital market investors, right? Like investment banks or mutual funds and stuff. But those big players, they have a lot of money, so they could potentially be hedge providers to longevity risk. So this idea has been argued for a very long time, probably 2 decades already. And here I only cite a few papers, but there are literally maybe 100 papers about capital market solutions, okay, on LRT. So compared to the traditional reinsurance sector, there are some theoretical advantage for capital market solutions. So first of all, by introducing capital market players to the market, to the game, everybody could, well, pension funds, life insurance companies, etc., they would have better access to a broader capital pool, right? So this is good. And this is good for one side of the transaction, the buyers, the hedgers, right? But for the other side of the transaction, the capital market investors, this is also potentially good because longevity risk is sort of like a zero beta risk for them, right? Because most of the portfolio of an investment bank, for example, is on the equity market or real estate or something else, financial assets. But longevity risk obviously has a very weak correlation with those assets most of the time, right? Except for COVID, these kind of rare events, you may see a increase in mortality and decrease in the stock market at the same time. But most likely, most of the normal time, you see very weak correlation. So this is
a question.
Yeah.
Sorry that I'm asking too many questions, but this is an interesting topic, and then when you get older, you become very important. Just out of curiosity, you were mentioning hedging, right?
Yes.
But you said yourself that this is a zero beta risk. So it's not really hedging. When I was thinking when you were talking, there's this huge industry of all the people houses. I don't really know how those houses are called. I think that this would be a natural hedge to the longevity risk, because while for the pension funds it's a loss, obviously the longer I live, the worse for them. For the old people house, it's actually good because the longer I live, the longer I stay with them, right? That's all I pay for them. So did you see anything in this direction?
Well, this is actually a very good idea. I have actually never thought about this, but I can see the point here. So this could be.
This would be a hedge, a real hedge.
Yeah,
it's not a zero beta risk.
Exactly. Oh. Yeah. Oh, well, so going back to your question, yes. So, well, for the capital market investors, for the mutual funds or investment banks, can be considered as a zero beta risk. Zero beta in the sense that, to the equity market, it's a zero beta risk. But for this hedging, the hedging is for the hedgers, for the pension funds, and for the liability holders, right? So for the institutions that already have longevity risk, so this they want to hedge, they want to offload the risk. Yeah. So hedging is not for.
Okay.
Yeah. But what you brought is a very good point. I really should look at it. I don't know if anyone has done anything about it, but yeah.
Because they also have stocks, I think, the industry there, right?
Yeah.
So they would be on the stock market as well.
You're right. Yeah, this is actually a very good point. I should think about it, definitely. Yes, yeah, but that aside, so let's
Sure.
keep going. Yes. And they have potentially lower costs because for those major financial market players, things are very different for them, right? So for insurance company, risk is a big part of the portfolio, and if you want to manage risk, you probably want to charge a higher cost. But for general market players, they would probably look at this thing from a different perspective, and they might be able to accept a lower cost because they are enjoying diversification benefits and etc. But keep in mind that all I have said here are all theoretical advantage, because at the moment the capital market development has been very, very slow. For the past 2 decades or so. Okay, ever since people started advertising it, well, the development is disappointingly slow. So here I have just put some facts here. So the most remarkable failure in this market is probably the 2005 bond withdrawal. So in 2003, the European Investment Bank, the BNP Paribas, and a reinsurance company, Partner Re, they initiated a longevity bond, which is a very long-term bond, maybe 25 years, 30 years or so. This is one of the very few first attempt to securitize longevity risk, but obviously they failed. They didn't attract enough demand. So 2 years later, in 2005, they withdrew the bond from the market and they stopped trying, I guess. And also starting from around the same time, there are some major financial market players like JP Morgan, Goldman Sachs, and the Deutsche Bank. They have stepped foot in the longevity risk market, but after a few years, they withdraw as well. So obviously, the capital market players, they are not really comfortable or not really interested in these kind of LRT transactions. So a natural question for people like us to ask is, why is that the case, right? So why is the capital market so unsuccessful, right? So this is also one motivation of our analysis later. And of course, there are many explanations of the failure of the capital market. And one explanation is, well, that capital market players, they are not really familiar with longevity risk, right? So this is, well, there are many other factors, but one of them is they don't really understand the risk. So in that case, well, if you don't understand the risk, you may be a bit more averse to hold the risk. And also because this market is far from being complete. So if you don't know the risk and you take the risk, and if you realize you don't like the risk some point later, you are not able to offload the risk. I mean, for capital market players, it's very hard for them to do so, at least. So they are more averse to the risk, and also there could be information asymmetry in the sense that they are afraid of buying a lemon, right? So because they would think that, okay, so the counterparty, the insurance companies, they know better about the longevity risk. So they might be cherry picking and stuff. They might intentionally sell a bad portion of risk to the investment banks, right? So they don't like that. So these are some potential explanations of the failure of the capital market. And while there have been many attempts to attract capital market players to the game for a long time, and most of them have not been successful. And until recently, in 2017, there was the first ever longevity sidecars. So do you know? I guess you know what a sidecar is. A sidecar is a very traditional, a very well-established methods to attract external capitals in the P&C market, in the P&C insurance market. So the idea is that for a reinsurance company, if I want to reinsure some P&C risk, I need to have capital reserve. I need to put money aside before I can write the business. But when the market is bad, when there are risks all over the place, and I might not have enough money to write all the business that I want to write. So and I don't want to issue new equity just for writing new business. So what can I do? Well, I have to raise money from elsewhere. And one thing that I can do is to use sidecars, right? So sidecars, they are very short term, 1 year or maybe 3 to 5 years, like financing vehicles, something like that. So you can just attract money from the capital market for a term of 3 to 5 years. You can use the money to write new business and stuff like that. And after 3 or 5 years, you have to share the returns or the loss from your underwriting business with the investor, something like that. So these are short-term financing vehicles that are very popular in the P&C market. But because of the long-term nature of longevity risk, these sidecars was not existing until 2017, where a firm has tried to establish this sidecar, and the money will be used to write annuity business or to insure their annuity portfolios. So this is sort of like a longevity sidecar. And so far, this thing is pretty new, still pretty new. But the first sidecar expired in 2020 and it got renewed. So looks promising. Anyway, so this is one attempt that could, well, potentially attract capital market players into the game. And yeah, so I'll also talk a little bit about this later. So it's already 11:30, so I'm gonna go faster. I mean, I intentionally spend a lot of time in the motivation part because I don't want to lose your interest very fast. So now that's the big picture. Okay, that's the background. And so in this paper, we are gonna propose a model trying to explain the empirical facts that I have just mentioned in the LRT market. And we try to provide some insights on the development of the capital markets in LRT transactions. And what we're doing in this model is we look at the role of risk aversion, okay, and the impact of risk aversion on the preferred contract types and the market dynamics, okay, whether a market would exist or whether a market would not exist. And just to summarize, our findings includes some key points here. So in a market where the buyer is the hedger, the buyer is a pension plan, okay? The buyer wants to buy a longevity swap or buy a reinsurance. So we call pension plans as a buyer. So if the buyer is more risk averse than the seller of the swap, longevity swap or longevity reinsurance, then this market as a whole would prefer a long-term contract. So this is something that we observe in the insurance sector, that long-term contracts are dominating. Okay, and on the other hand, when the seller of the contract is more risk averse than the buyer, so if the risk aversion is flipped, then in this case, the market would prefer short-term contracts. So short-term means dynamic because the liability is long-term, right? So if you sign a short-term contract, you have to renew after a few years. So this is dynamic. So that's why I put dynamic and static there. Okay, so these are the two findings. And then we also find that in the presence of information asymmetry, and here we model information asymmetry using ambiguity. And so in the presence of ambiguity, market could collapse. Okay, so potentially there could be no transaction happen in the market if the degree of ambiguity is strong enough, right? So this could potentially explain why capital market transactions have been so rare. So, but I will go into a bit more details as we go along. And so this is longevity risk is a very well-studied topic. So there are literally hundreds of papers. So here I just cite a few of them. And information asymmetry also very well-studied topic. Ambiguity also tons of papers. But yeah, these are sort of like the papers that are a little bit more closer to our study. Okay, so that's the motivation. And now let's get to the model. The model is actually pretty technical, and I didn't do most of the derivation. So I'm just gonna show you the setup, the optimization problem, and then let's just jump to the numerical results. So the model is pretty simplified. We consider one buyer and one seller engaged in a LRT contract. And the buyer has a longevity, portfolio, right? So the buyer has a life annuity portfolio for L0 annuitants at time zero. And these annuitants will receive $1 annually for life, right? So this could be a life annuity portfolio. This could be a defined benefit pension portfolio. Mathematically, they are equivalent. And longevity risk comes from the uncertainty of the number of surviving annuitants over time. So L0 is known, it's the number at time zero, but LT is not known. So over time, how many people would be alive in the portfolio? We don't know, right? So this is longevity risk. And so because we are going to incorporate ambiguity at some point, so we will first introduce a reference probability measure. So this measure reflects the seller's most credible risk assessment, okay? Because information asymmetry goes only one way. So the seller is not really certain about the longevity risk there, right? So the seller would have a reference portfolio, a reference measure, and the seller would also have an ambiguity set or something like that.
The buyer shares the P with the seller, correct?
The P.
The probability measure, the reference probability measure.
Yeah.
The buyer, right? How the seller knows.
It could come from the buyer or it could come from the seller's investigation or anything. So we didn't really specify that. So in the presence of ambiguity, the true measure, a measure means the surviving probability, right? So the true probability, it could be the same as the reference measure, it could be different. We didn't really talk about how did the seller get this reference measure. So the buyer could share the P with the seller, the buyer could lie to the seller, right? or the P could be obtained by the seller's own investigation. So we just assume that there is a reference P, and this P could or may or may not coincide with the true probabilities. Right. And then, so this is the reference measure, and then we also have the surviving probabilities. So these are PXT, so these are the actual surviving probabilities. So under perfect information, and these real probabilities are known by the seller. In the presence of ambiguity, they are not known by the seller. So that's the idea. That in the presence of ambiguity, the seller would have estimation because they don't know the true value, so they would estimate these probabilities, and they could estimate the probability using different measures. And for the sake of convenience, we just use TP hat to denote the estimates using the reference measure. Okay, because the reference measure is going to be used to set the rates, the price, etc. in the contracts. So we use TPX hat to denote the reference measure estimation. And given the survival probabilities, the future number of annuitants alive will follow a binomial distribution like this. Okay, at t plus 1, the number of annuitants alive follow a binomial distribution with LT, the number of alive annuitants one period ahead, and the probability. Probability. Okay, yes, just set up. And here we just define the buyer and the seller's wealth dynamics. So for the buyer, so we abstract from a financial market, so the dynamics are pretty straightforward, I hope. So at time t, the buyer's wealth would be, its wealth at time t minus 1 accumulated by the risk-free interest rate. And also at time t, the buyer has to pay LT. LT is the annuity payment, right? So LT depends on the number of people alive in the portfolio at time t. So this is the dynamics. So there's no, financial investment return or anything like that. Okay, and as a hedging instrument, we consider a longevity swap contract, and the longevity swap basically exchange a fixed premium for a fluctuating cash flow, and this fluctuating cash flow, it would be based on the realized number LT of the people alive in the portfolio annually at every time t. And here, given a longevity swap contract, the two parties could decide a hedge rate. A hedge rate means the proportion of the liability that you want to hedge. 0 means no hedge, 1 means full hedge. And you have a risk loading that is defined here in this formula. So basically, the idea is that at every period t, if the realized number of people in the portfolio is larger than the estimated number LT hat, well, LT hat is set, before time t. So I will talk about how LT hat is set in different contract structure later on, but LT hat is just an estimated number. And so if the real LT is larger than LT hat multiplied by a risk loading, then in this case, it means that the real number of people in the portfolio is really high. It's really higher than expected. So in this case, the buyer will be compensated. The buyer will receive a payment of the difference between LT and 1 plus beta times LT hat as its compensation. And of course, this number will be multiplied by a hash rate. Okay, again, 0 means no hash, so the buyer is not going to receive anything. 1 means full hash. And on the other hand, if the true LT is smaller than the estimated value multiplied by a loading, then it means that the longevity risk is not really that large. So in this case, the seller would receive a payment. Okay, so in this, you can think of this as a buyer paying premium, right? So in this case, the seller will receive a payment here. Okay, so this is a swap, right? You have a fixed rate, you have a floating rate, and two-party exchanges payments, cash flows. Okay, so after incorporating this longevity swap, the buyer and the seller's wealth process looks like this. So now the buyer's wealth now depends on the hash rate of the longevity swap, right? But the structure is pretty similar. So at each point of time, the wealth equals to the wealth in the last periods accumulated by the risk-free interest rate minus the annuity payments and minus the the net payment received from the swap. And for the seller, this is the other way around. And for the seller, we assume that there's no pre-existing assets or liability. So at each point of time, again, the wealth would be the wealth from the previous period accumulated and including the net payment from the swap. Okay, so that's the idea of hedging. Okay, so now let's introduce the two contract structures. So here, again, the structures are pretty simplified. So we consider a long-term contract and a short-term contract. And I mean, well, it's better to phrase them as a static contract and a dynamic contract. And basically, the idea is that, well, both contracts would cover the whole life of the liability. So both contracts will be long-term. The only difference is that for the static contract, the two parties will fix the hedge ratio at time zero. So everything is fixed at time zero. And the fixed payment in the swap, they are determined using information at time zero. Okay, so at time zero, you have to decide everything. You have to decide the fixed payment at every point of time in the future, and you have to decide a constant hedge rate. So this is static. Okay, you're not allowed to change anything. You will be really receiving a long-term hedge using a static contract. And on the other hand, for a dynamic contract, the thing is that at each point of time t, the buyer is allowed to change the hedge rate. Okay, the buyer is allowed to change the hedge. And this hedge rate would be a function of the information at time t. Okay, so they can change the hedge rate based on the latest information. And also, the fixed rates in the swap would be updated year by year. Okay, so the fixed rate L hat would be the time t time t expectation of would be of the real L. So this fixed rate will be updated time by time. So this means that if you buy a dynamic contract, you don't really know what you're going to pay out. So for a buyer, you don't really know what your fixed leg is. Your fixed payment is updated every period of time. So you don't really know how much you're going to pay in the future to hedge your risk. And you can change your hedge rate every time. So this is really similar to a rolling of short-term instruments, right? So this is really like a rolling of sidecars, for example. The one sidecar has a life of 1 year, and after a year, you have to negotiate everything from the scratch. Okay, so this is a dynamic contract. Okay, so you have two contracts in here, and now let's look at the game between the buyer and the seller. So we are going to consider a Stackelberg game between the buyer and the seller. So the idea is that, well, the two parties, they want to decide several key parameters. They want to decide, first of all, the hedge rate for a contract, right? And then they want to decide the risk loading eta, right? How much money I want to charge, the seller wants to charge for providing the protection, right? So there are two key parameters to be chosen, the hedge rate and the risk loading. So we use the Stackelberg game to do that. So the seller is the leader, the buyer is the follower, and the game goes like this. The Stackelberg game is a sequential game, right? So basically, the idea is that the seller would design a contract taking into account the buyer's reaction. Okay, so that's the idea. So the seller would have this mind game playing in his mind. So he would think, okay, so now if I offer a eta, so what would the buyer do based on that eta, right? So if I set a higher eta, then the buyer would buy less of a swap. If I set a lower eta, the buyer would buy more, right? Something like that. But if I set a lower eta, I'm going to earn less, something like that, right? So the seller would anticipate the buyer's best response based on each eta. And after this mind game, the seller would set the eta such that his expected profit is maximized, expected utility is maximized, right? Something like that. So this is a Stackelberg game. So we use that game to determine the optimal hash rate and the optimal risk loading for each contract. And we are going to play separate games for the two contract structures separately. Okay, so one game for the static contract, one game for the dynamic contract. So that the comparison becomes clearer. That's the idea. And the optimization problem is like this. So we use mean variance utility function for both the buyer and the seller. right? So basically, for the buyer, given each eta, the buyer would choose the optimal hash rate to optimize its expected utility. And for the seller would anticipate the buyer's best response based on each eta, right? So with that information in mind, the seller would choose an optimal eta to maximize its expected utility, something like that, right? And for a static contract, the hash rate would be a constant U for every T. And for a dynamic contract, UT depends on time, right? And you have gamma B, gamma S, the RISC aversion parameters. Okay, so that's the idea when you don't have any information asymmetry. And when you do have information asymmetry, so in this case, we introduce ambiguity to the problem. And in this case, well, so I have some slides about some very general idea about ambiguity. So for the sake of time, I'm gonna just skip that. So basically, we are gonna use the min max. So I'm gonna use the min max optimization approach here. So basically, in the presence of ambiguity, the seller doesn't really know the true probability of the portfolio. So the seller would consider a set of all possible measures, like all this the set of Q. And then when the seller optimizes expected utility, it will consider the worst case scenario from this set of ambiguity, right? So that's the idea. Okay, so it's a mini-max optimization problem. Well, solving this problem is not trivial. Okay, you have a mini-max optimization. You have a dynamic optimization problem here. You have mean variance objective function, which is not time consistent. So I'm not in charge of any of these derivations. So my co-authors did that. So the idea is that we don't have any closed form solution, so everything have to be rely on numerical simulations. So I'm going to show you the simulation later. And here, this slide is just about how we simulate future mortality rates. So we use a well-established model using by IFOA, the society in the UK, to generate their mortality table. We just fit this model to the historical data in UK, and then we do simulation, right? So the idea is that we first simulate mortality, the survival probabilities from the reference measure, and then we twist the reference measure to get all the measures in the ambiguity set, something like that. So these are all technical details. So let me just tell you the main story. So in terms of the quantification of ambiguity, we just look at something like this. So this is actually also what people do very often in reality. So the idea is that if I have a portfolio, I can estimate the life expectancy for this portfolio, but this is just my estimation. My estimation could be wrong. So in terms of ambiguity, I would consider, hey, so what if the real life expectancy is maybe 5% lower or 5% higher than my estimation, right? So this is a way to quantify ambiguity. So we quantify ambiguity in this way. Okay, so the ambiguity set is constructed in this way. The ambiguity set would include all probability measures that will lead to a real life expectancy that is within plus minus maybe 10% of the reference estimate, something like that. Okay, so now let me go through some key numerical results. So here I'm going to use set up my optimization problem, my mortality model to do the simulation, and I'm going to look at two scenarios here. The first scenario is when the buyer is more risk averse. So here gamma B is 0.3, gamma S is 0.1. So gamma B is higher. And the second scenario is the seller is more risk averse. So in this case, gamma B is 0.1, gamma S is 0.3, right? It's split. And some other parameters, initial age 65, time zero. At time zero, the annuitants are 65 years old, duration 35 years, initial portfolio size 10,000, risk-free interest rate 2%. So these are some other parameters. Now, let me show you this figure. So now, first of all, I'm going to consider a benchmark case when there's no ambiguity, so everybody knows everything, and when the buyer is more risk averse, and then I'm going to compare the welfare, the improvement of utility for for the seller and the buyer, so sorry. So the title here is not correct. So here A should be the seller, B should be the buyer. Okay, so I'm gonna look at the improvement in utility by trading both contracts for both parties. And the red line here is, the utility improvement if a dynamic contract is traded with an eta. So the horizontal axis is the eta, the risk loading. The vertical axis is the improvement in utility. The red line is the dynamic contract. The blue line is the static contract. So the idea is that if I trade a static contract with eta equals to 0.2, for example, then the utility improvement for the seller would be something like this, would be this high, right? About 150, something like that. And similarly for the buyer, the right panel for the buyer is the same. So if I'm able to trade a static contract with eta equals to 0.2, my utility improvement is gonna be this high, about 500. So that's the idea. So the figure here shows it delivers two informations. The first information is which contract could give me the highest utility improvement, for the seller and the buyer separately. So the left panel is the seller, right? So for the seller, I can get a maximum utility improvement by trading a static contract. Okay, in this case, higher, right? And the optimal eta here would be around 0.3, around 0.3, right? And so this is the first information. The static contract is better. And the second information is, so here, if you look at this curve, there is a certain interval of eta such that I'm gonna get a positive utility improvement, right? So for example, if I trade a static contract and if eta is beyond 0.5, if eta is very high, then in this case, the seller is not gonna buy anything. So in this case, I'm gonna get 0 utility improvement, something like that, right? So in this sense, this interval of eta is just sort of a interval for market existence, right? So if my eta goes out of this interval, there will be no transaction. So there's no market. So if you look at the two intervals, one for the red line, one for the blue line, we can see that the interval for the red line is much shorter, right? So it's much harder for the market to exist for dynamic contracts, right? So there are two information, two findings from this figure. And then from the buyer side, so the two dots here are the optimal eta that the seller would provide, okay, for each contract type. And we can see that with the optimal eta, the static contract will give the buyer a higher utility improvement. So all in all, so when the buyer is more risk averse, the market would prefer a static contract, and the market for static contract is easier to exist. So based on our results. And here we have the case of ambiguity. So when there is ambiguity, obviously everything is going to be worse, right? So here, let's first focus on the seller's utility improvement. And the left figure is for static contract, the right figure for dynamic contract. And the takeaway information here is when there is ambiguity or when ambiguity is larger, of course, the maximal utility improvement that you can achieve is lower, right? Everything is worse. So this is one thing. And the second thing is that when there is ambiguity, the range of eta that transactions would exist is becoming shorter as well. So the information here is when there's ambiguity, it is harder for a market to exist. And this observation is consistent for both contract types, right? So you observe very similar pattern in both figures. So this is for the seller. And for the buyer, this is the utility improvement with ambiguity and with two contract type, okay? And so I probably don't have time to go into the details, but basically, the blue line is higher, meaning that for the buyer, because in the presence of ambiguity, so the buyer could have different probability measure of their, survival probabilities, right? So for each type of the buyer here, the static contract is better than the dynamic contract here, right? In this case. So the static contract has a higher utility improvement. And figure A and figure B presents two scenarios of ambiguity. So in figure B, the degree of ambiguity is much higher. So in the extreme case, there might be some scenarios where the dynamic contract is more preferred, but these scenarios are highly unlikely. It means, so this scenario means that the seller strongly overestimate the longevity risk of the buyer. So the buyer and the seller, they have a huge discrepancy in information, and only in those cases the static contract will be worse. Okay. So that's the observation. So the idea here is that for a long-term liability, it's better to have a long-term hedging, a static contract, when the buyer is more risk averse. Okay. And now here we have the second scenario. So I'm just going to quickly go over the figures for the second scenario where the seller is more risk averse. So now the risk aversion is flipped. In this case, we can see that the results are different. So the dynamic contract can give you a larger utility improvement than the static one for the seller. And for the buyer, the two contracts will give you comparable utility improvement, but because the seller prefers the dynamic contract here, so the seller would only offer a dynamic contract in the market. So this red point is the utility improvement that can be achieved by the buyer. Okay, so again, the message here is the dynamic contract becomes more preferred by the seller. And then the next figure is in the presence of ambiguity, we see similar results. So first of all, when there is ambiguity, the maximal utility improvement becomes lower for both contracts. And so this is the first observation. The second observation is pretty interesting. So here, when the seller is more risk averse and when there is ambiguity, there will be a case where, offering the static contract would provide zero utility improvement for the seller all the time, right? So you see, if you look at the bottom line here, so for any possible eta, the utility improvement is either zero or negative, meaning that in this case, the seller has zero incentive to offer long-term static contract. But for the dynamic contract, we don't observe this scenario here. So from the degree of ambiguities that we consider, there are always a market for the dynamic contract. Okay. Now, the final figure here is the utility improvement for the buyer. So we can see that the dynamic contract is more preferred all the time. Okay, so this is what we have, what we found, and now the final thing. So the final thing is some insights into the longevity market. So we have looked at a model with ambiguity and with two different scenarios of different risk aversions, and we see those results that we have just discussed. And now we are trying to connect the findings of our model to the real longevity market, right? So first of all, if we look at the reinsurance sector, we argue here that in the reinsurance sector, buyers are actually more risk averse than the sellers because of various reasons. So first of all, buyers are smaller. They have a smaller portfolio than reinsurance companies. So because buyers are pension plans and life insurance companies, they are typically smaller. They face more systematic risk, and they face stricter solvency constraints. So these all motivates that the buyer could be more risk averse than the seller in the longevity in the reinsurance sector. Okay, and because of that, based on our model prediction, in this case, the market would prefer a static contract, and the market is harder to collapse, right? So this is consistent with our observation. In reality, most of the reinsurance transactions are long-term, static, and there are a lot of reinsurance transactions all over the place, which means that the market is pretty active, right? It does not collapse. And the second market is the capital market. So in this market, we argue that in this market, the sellers are more risk averse because in this case, the buyer in this capital market are typically global reinsurers. They're pretty big, They know the risk very well. They have all kinds of ways to diversify or to hedge longevity risk through all kinds of channels. So in this sense, they might be less risk averse than the capital market buyer, the capital market investors, because these investors, first of all, they don't really know about the risk very well. And second of all, the market for longevity risk transaction is so incomplete, so they are not able to get rid of the risk if they realize that they don't like it in the future, right? So all this could motivate that capital market investors are more risk averse. And based on our model prediction, well, as we have seen here, so the market for longevity, so for the capital market for LRT, first of all, it would not prefer a long-term contract. And second of all, the market is very easy to collapse. It's very easy to have a case where there's no transaction at all, right? So this is the implication for the capital market. And the final point here is that we also find that when the seller is more risk averse, the short-term dynamic contract would be more preferred. So this comes back to the sidecar thing. So we argue that, okay, so we have witnessed the first sidecar 7 years ago, and it seems to be promising. And based on our model prediction, we argue that short-term instruments like sidecar are indeed a promising solution to activate the capital market. So although the ultimate goal of the longevity market is to develop long-term capital market solutions because longevity risk is long-term in nature, but we haven't get there in one step. So short-term instruments like sidecar seems to be a promising first step solution towards a more liquid and more active capital market for longevity risk transfer. So that is basically the paper. I spent a lot of time in the background, but I hope that the takeaway message are clear. Okay, I skip all the technical details, but basically we propose a model which investigates the impact of risk aversion on contract type and market existence, and then we find that when the buyer is more risk averse, then the long-term contracts are more preferred, and the market is harder to collapse. And when the seller is more risk averse, then dynamic contracts are preferred, and the market is easier to collapse in the presence of ambiguity, which means information asymmetry, right? And we also argue that the emerging short-term instruments like sidecar could be a promising first step to a mature capital market for longevity risk transfer. Okay, yeah, so that's so much of my talk today.
One question. So first, thank you so much for the very interesting talk. So my question is, since you consider the mean variance criteria, so I'm wondering whether you consider pre-commitment strategy, because that will lead to a third type of structure, something between the static one and the dynamic one.
Yeah.
It will allow for, say, time-dependent hedge ratio, just that those time-dependent UT will have to be decided at time 0 and will be committed to at later time points.
Yes. So this is a good question. So first of all, we didn't do that. Well, I was not. My technical abilities doesn't allow me to do that, and my co-authors they didn't do that. But to answer so I think I can answer your question from a qualitative point of view. So if you think about the comparison between a static and a dynamic contract, so for a fully dynamic contract, the buyer is allowed to change the hedge ratio at every point of time, and based on the latest information. And if for a pre-commitment contract, the buyer would commit to the strategy, but the thing is that in a dynamic framework, the buyer doesn't really know about the fixed payment in the future. Right, so the L heads, right? So this is a very well. What we consider this as we have discussed this case internally. We think this is not a very common thing in reality. Like, okay, so I fix my hedge ratio, but I don't know what the premiums will be. Right, so for swap, I don't know what my fixed leg will be every point of time. So it's all uncertain. But nevertheless, you ask me to commit to a fixed schedule of hedge ratio. Right. So for the current framework, a static contract is really a static contract, right? You buy and hold, nothing will be changed. A dynamic contract is really like you roll over, short-term instruments over time. It's really dynamic. Everything is dynamic, right? Yeah, thanks. Yeah, right, yeah, right. Yeah, sorry, my understanding of this terminology is pretty. So I might have used incorrect words. But so for the dynamic contract here, so at every point of time t, you negotiate everything from the scratch, right? So this way. But for the pre-commitment contract, it's like, well, as I said, you pre-commit to a cash ratio, but at that point of time, you don't really know what your premium will be, what your L hat will be. So it might turn out that your L hat over time will be much higher than you thought at time zero, but you are committed to a fixed hedge ratio from. So we are not sure if this is really like something that sounds attractive to the buyers, right? And yes. And in that sense, we didn't really do the analysis, but we expect that if we propose that contract, it will be worse than close the. Yeah, just because of this reasoning, we didn't really do the analysis. Yeah. Yeah.
And ask one more question. Yeah, so instead of introducing model ambiguity, have you considered using contract design to overcome the information asymmetry?
Yeah, that's a good point. So we will probably do it in the future, but so far we haven't done it because so for this paper, I guess our information, our focus is on the risk aversion and contract preference, right? So in fact, our here results holds even without ambiguity, or maybe this figure is more clear. So even without ambiguity, we see that risk aversion has an impact on the preferred contract structure. So because of that, we want to emphasize these findings. So we don't want to go into the classic way of dealing with information asymmetry, because in that way, you have to offer a separating equilibrium, right? So you have to offer a menu of contracts for different type of investors. So that will make the analysis here a bit messier, so to speak. And in particular, if we want to consider a continuum type of buyers, right? So here, in terms of ambiguity, it's pretty clear. No matter how many types of buyers there are, I offer only one contract. I look at the worst case, right? But for a classic way, if there is a continuum of type of buyers, you would have to offer really a big menu of contracts. So it would be very interesting to do that if information asymmetry is the focus. But information asymmetry is not the focus here, so we didn't do it. But yes, we have also actually talked about this yesterday. So we thought it might be interesting to look at the classic way to deal with information asymmetry, probably in the next paper. I don't know. Yeah.
Yeah, quite interesting.
Yeah.
Questions from the remote attendees? I mean, I have many questions, but I'm just,
We can
I
talk.
really have already exhausted my order.
We can talk about this later.
Yeah, we'll take that time.
Okay, thank you for today.
Yeah, thank you for having me.
Please grab a cookie and coffee.